Yeah, I'm losing my edge.
Pete, today I want to talk to you about successful strategies for 50-50 trading. We live in a 50-50 world here, Pete, with futures trading and direction. I guess you would say same with stock trading. Anyone who's got a Robinhood app is living in a 50-50 world, whether they know it or not. But when you're choosing direction in futures, people tend to think about this 50-50 scenario. You want to highlight just like what that means? Like, say I'm looking today at the small precious metals market, calling it a 50-50 trade, both right now, tomorrow at the open, or for the next week or month. What does that necessarily mean to you?
Well, that markets are random and there is no, we talk about sometimes visualizing certain levels, and they help us construct realistic expectations. Around 50-50 trading is all about around management, both for the good and for the bad. And 50-50 means a purely directional trade in a neutral security. And that means security that you can sell or buy as easily on one side as the other, which futures are, is a 50-50 bet. It's a coin toss. So how can we take the randomness of that directional bet, where certainly we have an assumption, but you've got to weigh the fact that that assumption is going into an efficiently priced market, that's really making that a 50-50 bet. So that is what we talk about with static delta directional trading, and the realistic nature of what you're getting when you express that opinion.
Absolutely agree. And you look at small precious metals here, and you could look at gold individually, silver, the price of small precious metals even higher than when I created this graphic last night. And you might say, well, actually, no, you might say everyone is going to have an opinion on this chart, and everyone is going to think,
isn't that the truth?
Everyone's going to think that their opinion is going to be right, or at least better than 50-50. And the real strategy behind trading futures is simply getting an opinion, or some kind of a lot of people like, man, I can't believe I'm blanking on this term, signals, getting a signal,
Sure,
or something else that does create a better than 50-50 scenario. But Pete, the idea that you just posed is, okay, this market's at 80. Its recent high for 2020, leading up to the run of the last couple of weeks, was about 60, 65. And its high for going back testing this product until 2016 was 60 or 65. And so whatever signal or opinion or anything you have, you probably can apply it to a market like this that's moving a ton. But the idea is, right now, this market, and this is anyone who's studied applied mathematics, you could think about any time frame, right? Like the next second, the next minute, the next week, the next year. There's an equal opportunity of this market both being higher or being lower. And that's this 50-50 idea for directional trading. And it's the same that goes for, like I said, if you have a Robinhood app and you're trading around Tesla or whatever, and Tesla is tripled in the last couple of months, and it's as high as it's ever been, whether you have an opinion or a strategy or whatever, there is, in theory, a 50-50 chance that market will be higher or lower in whatever time frame. I want to work within the time frame of a week here, Pete, and I want to look at the strategy of just getting on the other side of big moves, something that a lot of what you would call a contrarian trader is very used to. And you'd say, okay, this SPRE here has really moved higher. A contrarian would say, man, it's got to revert a little bit back to those normal historical prices. And so just looking at, if you sold SPRE after a 4% rise in a week, the next week's performance saw that sale be a winner 59% of the time, average P&L of about 0.2%, which would be close to $1 now, essentially, or $100 in SPRE. And oh wait, no, that's totally wrong. $20 in that product, and a max min P&L here of 14% or 9%. And so, Pete, these numbers don't necessarily look super sexy, but when you live in a world of 50-50 and you have a win rate that's 59%, an average P&L that's 0.2%, And this distribution here of 14% on your best day and 9% on your worst day, it's a lot better than 50% here, 0% here, and then 10% and 10% on either side of it, right?
Absolutely. And some of the most, and this is when I started trading, locals on the trading floor, if you could do 55, 45, because you were doing a tremendous volume of transactions, you were incredibly profitable. Now you look at the next evolution of a liquidity provider who is doing this automated over 40 exchanges and 1,000 products. They're working on 52, 48, and it's incredibly lucrative for them to build models around that. So when you look at this really sits outside of a juicy level in terms of looking at structure.
And we're not necessarily
you're never going to find, we all want that. We want that comfort around. We look at option selling around that, that probability of profit of 80% and 85% feeling. There, I know I'm far away. I'm not collecting a lot, but I've got statistically a high chance of making money on it.
Sure.
When you're looking at 50-50 theoretically or in actual fact, looking at these dynamics is a tremendous amount. It really is a tremendous amount of difference in terms of expectation.
Well, and I even want to hang on that for a second, because when you look at high probability strategies like selling a put in an options market, Pete, and you see that historical P&L of 80%, 90%.
Sorry.
Well, that put theoretically, when you sold it, had a probability of profit of 70% or 80%. So you still only got about 5 to 10% of edge. No matter what the market, whether it's a 50-50 directional trade in futures or, an 80-20 theoretical options trade in options on futures or options on stocks and ETFs, getting edge of, like you just said, Pete, 3 to 10% is really, really great. And this isn't, I'm not pitching this as like, this is the small stakes process here for making money. No, this is just an example, and it's it's an example that doesn't pop up very often in history here, where a 4% appreciation in this product in a week's time only probably happens once or twice a year. Right. We're seeing that right now. And here in a second, you'll see that, guess what? This happened 2 weeks ago, and it was wrong.
Right.
And this is where the mechanics part of it is. And just to cap off that last thought, this segment is not to pitch a strategy, this is the strategy you should look for in the future because it's got this win rate, it's got a positive. No, just giving you an idea of what to maybe look for to make your strategy. This is what your numbers need to resemble to get long-term success. But Pete, the mechanics piece of this is huge because you're going to be wrong 45% or 40% of the time. And it's a matter of, if I was right and I was going to take $50 or $100, that 55% of the time, great. Well, when I'm wrong, and that 45% of the time or 40% of the time, I better be only taking $50 or $100 in losses, because what you can see here is you're going to be wrong a fair amount of time, more amount of times than selling puts in a stock market. But if you let those losses exceed your average gain, that's when you're in trouble. What you need to do here, market moves up 4 or 5%. You get triggered for whatever strategy you're looking at. This is a strategy we're looking at here today. If I'm wrong that next day or that next minute even, Pete, I need to get out for that loss and move on, because I like I just said, I'm going to be wrong about 40, 45% of the time. When you don't do that, Pete, you look at what happened here. In the next week, this market was up another 5%. The next 2 weeks, you can see as of right now, this market's up more than 13%. And so without mechanics, Pete, your strategy could be honestly as good as 75% profitable on a 50-50 trade. If you don't have the mechanics, sometimes like you are seeing here, you could give back $1,000, maybe more like $800 when you're making just $100 every time. Not sustainable.
No, you've actually statistically engineered a no-win situation. The idea of prospect theory, the starting with whatever size account, the more you lose, the more on a percentage basis you have to make back to get back to zero. So the idea of taking advantage, there is nothing wrong with having an opinion, understanding the landscape, but the management of that opinion. And we often talk about identifying trade opportunity. And sometimes if, as you mentioned, that reasonable loss metric, and, I've shared this many times, when I look at a setup, I look at location and I don't look at what I can make on the trade. I first establish, is there a realistic spot where I can manage this when my ideas are wrong? And I think people will be surprised at the number. If you talk to traders who have done this for a while, the majority of them look at it that way. And then you attach a reasonable, given the elasticity of what markets are doing, a reasonable profit metric. But there has to be defined symmetry around it. And that mechanics of decision-making also helps you stay disciplined, because we've all I'm going to risk 500 or 50 ticks to the upside to make 100. Well, you know what? I thought they were cheap before or expensive before. Now they're really expensive. So I'm going to either add another one, which is absolutely, you never want to scale against losers, because that really destroys those probabilities, because you will never have on as many winning trades as you will losers. And
exactly.
That stops you from any statistical chance. So keep your units consistent, use tools, use reasonable metrics around trade location, entry and exit points, and then take advantage of it. There's nothing wrong with having an opinion. That is, that's part of the engagement around product. And the fact that you can express that opinion so capitally efficiently with futures is great. So it's just the management of that statistical 50-50 situation that becomes the key critical component.
Yeah. Opinions sometimes are the best strategies. Like if you want to be Warren Buffett with these futures markets, and you say, I think this thing's undervalued, I think that this thing is overvalued, as long as it gets you north of 50%, an opinion to me is a strategy. It's just a matter of, the moral of the story in terms of mechanics is symmetrical gains to losses. Like Pete said there, like if I'm losing on one unit and then I tack on another one because I'm losing, well, if you were winning, would you tack on another one while you were winning? Because if not, then you can't be doing that. And that's the scenario here. And really quickly, I just want to show how strategies like this usually apply to other markets and other scenarios. You see the US dollar as we speak getting its butt kicked below 150 through the lows of this. The same scenario as metals, just the opposite direction. If you're looking at buying SFX after a 1% down week, you're seeing very similar numbers here. And once again, this is a little bit of, I guess, a soft sell for contrarian trading, but I don't even care about talking about that today. It's not like, oh, Frank found a winning scenario. SFX selling off more than 1% in a week, the US dollar, I know that doesn't seem like a lot. That doesn't happen very often. So I wouldn't necessarily just wait for these two trades. But, you can apply your contrarian trading or your trend trading or your opinion-based trading to any of these products. And the only thing that's going to kill you is this market bounced 2 separate times since last Thursday, Pete, of $100 in profit. And if you didn't take it, you got greedy, you thought, oh, this market needs to get back to 152 or 154. Forget what I usually do. Now this market is back to 150 or even lower as we speak. You can have any kind of strategy, and you can make the mechanics a function of, I'll be in this trade for a week, or I'll be in this trade for $100, or I'll be in this trade for 2%. Whatever it is, as long as you're consistent with it, that's what's going to build long-term success past 50-50.